So let's review chapters 3 and 4 today. So chapter 3 is all about these adjusting entries, right? So every single adjusting entry is going to follow a couple rules. Your first rule that you can remember is that you'll either have a debit to an expense or a credit to a revenue in every single one of these adjusting entries. Another rule is that outside of those expense or revenue accounts, your other account's going to be a balance sheet account. So think assets and liabilities there. And then our last rule for adjusting entries is that we will never, ever use cash. And so the thought process there is that these adjusting entries are entries that we're making at the end of the month just to update some balances, record a few expenses and revenues that we didn't record throughout the month. If we would have used cash to pay for something, or if we would have received cash from a customer, then we know that we would have recorded that when it happened. So those kinds of transactions don't require adjusting entries. So you can be guaranteed that cash is not going to be involved in adjusting entries. So in this example problem, we have 5 different adjusting entries that we need to record. And then after we record that, we're going to prepare an adjusted trial balance. So we have this information given to us, as well as a trial balance for this company. So we have all of that information now over on the right. Hopefully it's not too small for you guys. So our first adjusting entry, we're told that $150 of the supplies were used in July. So what are we thinking for this adjusting entry? Correct. So the numbers in this entry is going to be the 150, right? This entry could be written a different way, or the information could be written a different way that tells you supplies on hand. And in that case, we would have had to subtract the amount of supplies on hand from the amount that we had in our supplies in our trial balance. So what kind of accounts are we thinking in this adjusting entry? Correct, Cassie. Yes, it's going to be supplies and supplies expense, right? So this adjusting entry is going to be a debit to your supplies expense and a credit to your supplies. So a few different ways we could walk ourselves through this entry. We know that $150 worth of supplies were used in July. That means that we need to decrease our supplies account by 150. Supplies is an asset, and so to decrease an asset, we credit that account. So that's how we know that we need to credit our supplies. Then we know based off of the rules that we have that we're either going to debit an expense or credit a revenue. Well, we have a debit slot open, so we know it's going to be an expense account. And you'll notice this pattern with these adjusting entries where we have some words that match up with each other, right? Supplies expense will go with supplies. We just need to record this expense showing that we used up these supplies that we had purchased. How about this next one? Employees are owed $1,800 and will be paid on August 2nd. How are we going to record this as an adjusting entry? Okay, so we will debit our salaries expense for $1,800. Correct, right? Salaries expense and salaries payable. So what we're doing here is we know that we owe our employees some money, right? $1,800. So that goes into our payable account to show that we owe them that money. So we credit that liability. And then once again, we have an expense as our debit. And what are we dealing with? We're dealing with salaries. So we'll call it salaries expense. A little bit of a trickier one here. The equipment has depreciated $125 this month. How do we want to journalize this?
Debit depreciation expense 125 and credit accumulated depreciation 25.
Perfect, right. Debit depreciation expense for $125 and credit our accumulated depreciation equipment for $125. So what kind of account is accumulated depreciation? It's a contra asset. So you guys will learn about some more contra assets later on in your course, but this is our first one that we're introduced to, right? So contra assets just work in an opposite way from regular assets. So accumulated depreciation is increasing with this credit. And this is just an account that will throw the depreciation into, and it just builds up over time, right? It accumulates over time. And then on a balance sheet, we would show our accumulated depreciation being taken away from the equipment account itself. So what's important to remember here is that when you are recording your depreciation, you don't want to affect the equipment account, right? The equipment account is only affected whenever you buy and sell equipment. When we're recording depreciation, we record the expense and we toss the depreciation into our contra asset account. How about number 4 here? $8,000 of the unearned revenue remains unearned. What do we think this might be? Okay, so this one's a little bit trickier, right? So we have to take a look up at our trial balance. And we see our unearned service revenue there, and it has a balance of 10,000. So what we are saying in that 4th bullet point is that 8,000 of that remains unearned. Another way to look at it is 2,000 have been earned, right? So what we're doing is we're taking it from the unearned revenue and putting it into just our regular revenue account. So our entry is going to be a debit to our unearned service revenue and a credit to service revenue. So remember that unearned service revenue is a liability account. So that's decreasing with this debit, and then we credit our service revenue account for that 2,000. And once we record that, we would then see that our unearned service revenue account would only have $8,000 left in it, which is what that bullet point is telling us. Now our last one. 1 month of the 6th month rental agreement has expired. What is this adjusting entry going to be?
Would it be
Rent expense for how much?
rent? 6,000 divided by
Right. So we're going to take the prepaid rent that we see in our trial balance of that 6,000, and we're going to divide it by the 6 months, because this is a 6-month rental agreement. And so we see that in 1 month, we use up $1,000 of that rent. So we need to record it as rent expense. And then our other account here is going to have to be a balance sheet account, right? Because we've already debited an expense. So what account do you think our credit will be here?
Prepaid rent, right?
Prepaid rent, right. So we are crediting our asset of prepaid rent to show that that balance has decreased, right? So these are our adjusting entries for this example here. Again, I want to point out the similarities in the words in the accounts, right? Supplies expense, supplies. Then we have salaries, salaries, depreciation, depreciation, service revenue, and rent, right? So if you're ever stuck and can't figure out what an account's supposed to be, just try and see, is there an expense account that might match up with what we're dealing with? 9 times out of 10, that's going to help you figure out what that other account needs to be. So are there any questions about these adjusting entries? Okay, so we have our trial balance that we were given, and then we have all of these adjusting entries. And so after that, we can then create something called an adjusted trial balance. So what's going to be different about this adjusted trial balance compared to just our regular trial balance that we see is that we are going to have more accounts and updated account balances, right? For example, in our first adjusting entry, we use the account supplies expense. Well, nowhere on our trial balance do we see the account supplies expense. So when we prepare an adjusted trial balance, we're going to need to add that into the group of accounts, right? So if we just work through this adjusted trial balance here, cash is going to be exactly the same, right? Because we didn't affect the cash balance whatsoever. Accounts receivable, we didn't affect accounts receivable at all. Supplies is our first change, right? We have a new updated balance of $350 because we used up some of our supplies in the month of July, right? So we update our supplies balance. Prepaid rent, we know that was $6,000 on our trial balance, but then we showed that we used up $1,000 worth in our adjusting entries. So now that decreases down to $5,000. Equipment did not change. What changed is that we now have accumulated depreciation equipment, right? So your contra asset is going to be listed immediately following the asset that it goes against, right? So for accumulated depreciation equipment, it's going to be listed immediately following your equipment account. So we list out our assets and our contra asset, and then we move on to our liabilities, right? Accounts payable, that wasn't affected. Unearned service revenue has a new updated balance because we recorded that $2,000 of our unearned service revenue was earned, right? So that decreased the balance down to that $8,000. And then we have to add in our salaries payable because our salaries payable was not on our initial trial balance, but we used it in our adjusting entries. Then we move on to our capital. Didn't touch that in our adjusting entries. Owner's drawings, that didn't have any changes made. Service revenue, we did have some service revenue in our adjusting entry, so we adjust that account balance. And then you'll notice all of our expenses. So we have salaries expense, rent expense, supplies expense, depreciation expense. We have to list out all of our expenses that we used in our adjusting entries or that we already had. And then just like a regular trial balance, we add up our debits and we add up our credits. So what's the purpose of making this adjusted trial balance? Why spend the time to do this? That's definitely true. Making sure that our account balances make sense, right? So in that way our debits equal our credits. There's one pretty big step that comes after making an adjusted trial balance.
Put it into the financial statement.
Perfect. Right. We make this adjusted trial balance. So in that way we have all of these balances and accounts in one spot. So then that way we can then prepare financial statements. Right? Otherwise, we have to look through a ledger or look through all of our T accounts when we're preparing these statements. So if we have one spot on our adjusted trial balance where we can see everything, it's going to make it a lot easier on us, right? For example, you need to create an income statement. Well, we just take a look at our revenues and our expenses, and they're all there for us, right? So remember that this is all part of that accounting cycle, right? So everything kind of builds off of each other. There's no steps in that accounting cycle that we just do for fun, right? We're doing this for a purpose, and we're making an adjusted trial balance, and that way we can use that when we prepare financial statements. So any questions about adjusting entries, adjusted trial balances before we move on to some Chapter 4 stuff? Yeah. Correct. So it's going to be made at the end of the period, but before you're adjusting entries. So we do that because we need to know, okay, what did we have in supplies to begin with, right? Because the way that you would probably treat these adjusting entries in real life is, well, I look in the supply closet and there's $100 left. And so we would need to know what we began with. And so that's why we make a trial balance first. Yep. Any other questions about adjusting entries or adjusted trial balances? Okay, well, let's move on. I know it says problem number 1. This is question number 2 here. So it says Victoria Lee Company had the following adjusted trial balance. We need to prepare the closing entries on June 30th, 2017, right? So we have this adjusted trial balance and we need to close out some accounts. So the last few steps of our accounting cycle, right? So what accounts get closed? Right, it's our temporary accounts, right? So what are the temporary accounts? Correct. Yep. So revenue, expense, and drawings are all temporary. And then there's this new account that popped up here in this chapter that we also close as well. But that account's only showing up when we do our closing entry. So let's walk through the process of our closing entries here. So the first thing that you're going to do is close your revenues to an account called income summary, right? That's that new account that showed up in this chapter. So step one will always be to close revenues to income summary. Step two will always be to close expenses to income summary. What's step three? Not quite yet. That's going to be our fourth and final step. Before we do that, what do we need to do?
Income summary and owner's capital.
Right, we're going to close income summary to owner's capital. And then we can close our owner's drawings to owner's capital. So you'll notice that revenues, expenses, income summary, and drawings are all closed. Those are all temporary accounts. Owner's capital is part of the closing process, but owner's capital itself will never be closed. So maybe taking a step back here, what does it mean to close an account? What are we doing? Right, that's all we have to do, right? Is zero out an account. So we need to make our revenues a zero balance. We need to make our expenses a zero balance. So if we want to do that, and the first step was to close our revenues to income summary, we then take a look at our adjusted trial balance over here. And we see that our service revenue account, that's our only revenue account that we have, has a balance of $4,300. What do we need to do to close out our service revenue?
Subtract the unearned service revenue.
No, we don't want to touch our unearned service revenue here. That's going to be a liability, so that kind of stays by itself. But in a
Debit the service revenue.
right, all we need to do is just debit service revenue for the amount of the balance. So we will debit our service revenue for this $4,300, which will cancel out the credit balance that it had. Right, so when you debit your service revenue here for $4,300, that then makes that revenue account's balance zero, because you are just canceling that out. And then we see that we close our revenue to our income summary account, and so we will credit income summary for $4,300. So what's our second step?
Credit expenses.
Right, we want to credit all of our expenses because those have a normal debit balance. So we want to do the opposite here to zero out those accounts. And then where do we close our expenses to? We close our expenses to income summary. Right, so what we're going to do here is we're first going to just credit our expenses for the amounts that were given in our adjusted trial balance. Right, salaries and wages expense, we were told that that was $1,260. Miscellaneous expense was $256. Supplies expense was $1,900. So we'll credit those amounts. How do we figure out what we need to debit income summary for? Right. We just have to add up our three expenses. So we add up our three expenses and we'll get 3416. Right? Because this goes all the way back to chapter 2, right? Where your debits have to equal your credits in your journal entries. So that's all we're doing here is our three credits add up to 3416. So that's the amount that we will debit our income summary for here. So step 3 was closing income summary to owner's capital. How can we figure out what income summary's balance is in order to close that account? Right. So we could also show it just like this, right? So in a T account form, we will subtract our debit from our credit, and we see the income summary now has this balance of 884. Right? So this 884, what would be another word to describe that number other than the balance in income summary? Profit is close.
Leftover
No. What was that going to be, Cassie? So it's not going to be a net loss. Susanna has it in the chat. This is going to be a net income because our revenues were 4,300. Our expenses were 3,416. Revenues minus expenses give us our net income, right? So this step of your closing entries, your third step here, when we close income summary to owner's capital, sometimes it's going to be referred to as closing income summary. Other times you may see it be referred to as closing net income. It's the same thing. So this 884 is your net income here, and it's a credit balance, right? So what are we going to need to do to the income summary account to close that account?
credit it.
Well, if something has a credit balance, we would debit it. So we will debit our income summary in this journal entry. And where do we close income summary to?
Owner's capital.
Owner's capital. So we will credit our owner's capital. Right? So remember that the order that we are writing out these journal entries is dependent on which accounts we are closing and what we need to do to close those accounts. Right? So for example, our first closing entry, we debited service revenue because to close revenue accounts, we have to debit them to bring that balance down to zero. In our second entry, we needed to credit all of our expenses because we needed to bring our expense accounts all the way down to zero. This third one, we debited income summary because after our first two entries, we saw that that account had a credit balance. So if an account has a credit balance, we have to do the opposite to close it. So we will put in our 884 that we solved for. And then we move on to our final closing entry. What was that final closing entry that we had? Owner's drawings, right? So owner's drawings has what? A debit balance or a credit balance? Normal debit balance. So we can also see that right over here in our adjusted trial balance as well, right? It's this 550. So if an account has a debit balance, what do we need to do to close that account? We need to credit it, right? So we'll credit our owner's drawings. And where do we close our owner's drawings to?
Owner's capital.
Owner's capital, right? So we debit our owner's capital here, credit our owner's drawings for the 550 that we see over there in the adjusted trial balance. So your first, second, and fourth closing entries will look pretty similar each time. You'll debit your revenues, credit income summary. Debit income summary, credit your expenses. And then in that last one, debit owner's capital, credit owner's drawings. Number 3, when you close income summary, that could be flipped. Here we had a net income, right? Our revenues were greater than our expenses. If we had a net loss, we would have to flip those accounts. But that's why I recommend making T accounts while doing this. Because we would have seen, if we would have had a net loss, we would have seen the income summary had a debit balance. And in order to close that, we would have had to credit income summary. Right? So if you write all this stuff down while working through these closing entries, you'll be able to talk yourself through the steps that you'll need to do. A few more things to talk about here. Your third and your fourth closing entries are kind of reflecting what happens on a owner's equity statement. Right? On an owner's equity statement, your capital increases whenever there's a net income. Well, in our third entry, we are increasing our capital by the amount of our net income. And then also on an owner's equity statement, your capital decreases by the amount of your owner's drawings. Here in this entry, we are decreasing our capital by the amount of our drawings of $550. So there's one thing that you would do after these closing entries. You could prepare a post-closing trial balance. What would go on a post-closing trial balance? Permanent accounts, right? So all of your assets, all of your liabilities, and owner's capital. So assets and liabilities were not affected in these closing entries, right? So those account balances would stay exactly the same. Your owner's capital, however, we wouldn't just want to put owner's capital at 5760 because there were some changes that happened to your owner's capital account in these closing entries. So what would your owner's capital balance be on that post-closing trial balance? So on our post-closing trial balance, right, we're trying to figure out the balance that we would put with owner's capital. So if we started with this 5760, then we take a look at how owner's capital was affected in our closing entries. Right? We increased owner's capital by 884 in our third closing entry. And then we decreased owner's capital by 550 in our last closing entry. So on the post-closing trial balance, we would then show owner's capital with a balance of 6,094, right? We could show that in T account form to show the differences and then figure out that number, or just take your 5760 plus 884 minus 550, and you should get that new balance of 6,094.